Those who are thinking of relocating to Guernsey always have questions about tax, and indeed we strongly recommend prospective new residents to speak to an expert about their specific circumstances. However, there are some questions which come up frequently, so we asked EY's tax director, David White, if he would answer a few of the most common questions for us. This is the first of 2 videos giving information about some of the tax issues which people need to think about at the beginning of the relocation process. So David, for those who are on temporary secondment to the island, say for a couple of years, what do they have to think about and what nasty surprises might they have on returning to the UK?
For anyone moving to Guernsey, the first thing to consider from a tax perspective is tax residence. This needs to be considered for both countries. Tax residence matters because it determines where you pay tax and on what income. You might be tax resident in both countries. This is not necessarily a bad thing, but does create a more complex situation from an administrative perspective. In Guernsey, tax residence is based on the number of days spent in Guernsey. If you're new to Guernsey and spend 91 days or more here in the tax year, you'll likely become Guernsey tax resident. If you're coming from the UK, determining your residence position can be complex. In the past, this was based on the number of days spent in the UK, but also your ties to the UK. The new UK statutory residence test is less subjective, but needs to be looked at based on the specific facts and circumstances of your departure. For people coming to Guernsey on a temporary secondment for a couple of years, it's possible that you'll retain your UK tax residency. This could mean you continue to be subject to UK tax on your worldwide income, but will likely claim a credit for Guernsey tax paid on the same income. This means filing tax returns in both countries. One of the advantages of Guernsey's tax system is that there's no tax on capital gains. However, even if you lose your UK tax residence, it's likely that you'll be treated as a temporary non-resident under the statutory residence test, even for periods up to 5 years away. This means that when you return to the UK, you may be taxable on capital gains and certain other income. For secondments, it's also necessary to consider your national insurance position. It's likely that you'll need to pay Guernsey social security payments rather than UK national insurance contributions. You should check with your employer whether there are any special arrangements applying in your case, and whether they need to apply for a certificate of coverage from the UK authorities. If you do start to pay Guernsey social security, this counts as part of your UK contributions record, so there's no need to top up with contributions in the UK.
What constitutes a tie to the country of origin, and should these ties be severed?
In the past, it was common for people coming from the UK to seek to sever UK ties to create a clean and distinct break. Some people sold their home, resigned from clubs and closed bank accounts and so forth. This was done to help prove that they were no longer UK tax resident. Now we've got a new set of UK statutory residence test rules, which means that ties are only relevant in some situations. For many people moving to Guernsey for employment, there's an automatic non-residence test, which means that you'll be treated as not UK resident without needing to consider ties to the UK. If you spend less than 91 days a year in the UK, you'll be automatically non-UK tax resident if you work for 35 hours a week on average in Guernsey and limit work in the UK to 30 days a year. In this case, you don't need to sever ties to the UK. Clearly care is needed, as there are definitions around what constitutes a work day, and the 35 hours a week calculation can become quite complex for those working limited hours. If the automatic non-residence test does not apply to you, there is an automatic residence test which would need to be considered. If neither of the automatic tests applies, then ties do become relevant. There are 5 potential ties which matter: the work tie, the close family tie, the accommodation tie, a 90 days in the UK tie, and a more time in the UK than anywhere else tie. Basically, the more ties you have, the shorter the number of days can be spent in the UK in order to avoid UK tax residence. In short, I'd recommend looking at how many ties you'll have based on your personal situation before simply severing as many ties as possible. If you're coming from a country other than the UK, you should check what the triggers are for losing tax residence there. It may be based on a simple day count or could be based on ties to that country. The other aspect to think about is domicile. A key feature of Guernsey's tax system is no inheritance tax or other capital taxes. It may be possible to acquire a new domicile in Guernsey if you're intending to move here permanently. This can be particularly beneficial if you are UK domiciled and may otherwise be subject to UK inheritance tax. Domicile is different to tax residence, and it's a long-term concept. If you want to demonstrate an intention to remain permanently in Guernsey, then severing ties will be a part of this. I'd recommend that you seek specific advice if you wish to change your domicile. and take advantage of relief from UK inheritance tax, as it is a very complex area with lots of pitfalls.